Hi guys. Wait for 3 minutes and we'll start. So guys, any questions from yesterday or day before? Anything with Greeks or anything with understanding calls and puts? We can cover that till the time some other people join. You guys can hear me?
Yes.
Okay. So anything you want me to discuss, or we jump into option strategies? You guys know how to unmute your mic and talk, because I can't hear anyone. You want me to unmute all?
Hi.
Hi Samir.
Hi. Actually, it's for the first time it's very difficult to understand in a one go.
Yeah, I know that.
Yeah. So right now, I'm just uh, going through your notes and all. Just try to
It's
understand the market.
kind of like a crash course. You
Yeah.
kind of get the broader picture, and then whatever you don't understand, you kind of dig deeper into that.
Yeah.
So that's the whole idea of, at least you have like the full picture of, what is linking to what, you know.
Yeah. Need to study the more because this is just a demo like a that.
Yeah, I get that.
But it's really nice to know the all the concept. The person who is means doing the day out day night. It's very good.
Yeah, thank you. Yesterday's website which you showed is paid. Yeah, basically I created this website, but when I shifted to Tradetron, I sold Options Tracker to this one company who's into education, Derivatives Trading Academy. So yeah, basically they have they they only provide it to students who join them. Basically, it's free for them. Cool. Let's go into option strategies. So we figured calls and puts. We figured individual legs, how the option is priced. Obviously, the aim is to buy low, sell high, or then sell high and then buy low. Means that's basically how money is made in any transaction. So the aim would remain the same over here, irrespective of the instrument. Or but here, when we are talking about option strategies, we are looking at hedging our positions and not having naked positions or just one leg. So that is what we'll go into. I'll share my page once again. Okay, so let's cover some basic ones. We can cover a bull call spread. We can cover bull put spread, bear put spread. Then we can cover a short straddle, and we can cover, what else can we cover? We can cover iron condor. Hey Vinay.
Hey Umesh, क्या हाल?
Bas, yeah, just started.
Cool.
You can see my pages screen.
Yeah.
Okay. So I was just going through what we'll cover today. If you have any option strategies which you want me to cover, you can let me know.
बॉस मेरे को मालूम ही नहीं कौन सा ऑफिस है, तू ही बता.
Okay. So I'll cover these basics. We'll spend time on what are the pros and cons of this, and
Done.
we should cover one ratio spread also. So let's cover a put ratio spread. Okay. So what is a bull call spread? We saw that at a particular strike, we can buy a call. We saw this yesterday. And if the market is going up, we will make money. And if the market is going down, we will lose money on this particular call which we've bought.
Yeah.
But now these calls are pretty expensive. And let's say that the market will go up a little bit, but not like a lot. So you want to reduce the amount of premium which you are paying. You want to reduce the amount of premium you're paying for this whole strategy. So what you will do is you will buy one strike, and then a few strikes ahead of this, you will sell a call.
Okay.
So now let's say you think that the market is going to be, it will go up. It's already gone up so much. And in the last so many days, so maybe it can go up to like 9,500, maybe. So what you will do is you will buy a 9,000 call. So here your loss is just limited because obviously you are buying an option. So even if it goes down, the maximum amount you will lose is the premium. Cool.
Okay.
So this has been already defined yesterday. And because you know that beyond 9,500 it should not go in this
Umesh,
particular.
your voice is buffering, huh? Again.
Okay. Let me see my Wi-Fi. No, I'm just in Is it better now?
अभी तो आया, ठीक है. Go.
Okay. So what I'll do if I think that 9,500 will not get breached, I will sell a 9,500 call. So now this becomes, so I'm bullish on the market, but only limited bullish. So this above is a bull call spread.
Bull call spread. Okay.
Yeah. So you are bullish. You are making this bullish position with calls. And because it is two different strikes, hence it is called a spread.
One sec, somebody switch on some music, man. Where's the music coming from?
Yeah, you can unmute yourself. You know.
Hmm.
So, got this part? We can we will cover the definitions of all of these at one go so that you know why they are called what they are called, and then we will go to options tracker and we will create each one of these and see the payoff chart so you know how exactly these option strategies behave and what you can expect as the market goes. So we covered this. Just take it in
This
for now.
9,001 is at the money. What is it?
You could create a bull call spread with anything. Let's say you think that the market can go above 9,500, but not about 10,000. So you can
Okay.
buy a 9,500 call and sell a 10,000 call. Your
Okay.
cost will be lesser. It will
Okay.
still be called a bull call spread. You
Okay.
could buy a 8,500 call. You think that the market will remain above 8,500, but it should not now breach 9,000. So you can sell a
Okay.
9,000 call.
Okay.
So this is also a bull call spread.
Hmm.
The strikes can keep differing. That's not a problem.
Okay.
Yeah. So now bear put spread.
So,
Again,
so in short, a bull call spread would be that I assume that the market will remain between this amount to this amount.
correct.
So I'm going to buy the base and sell the top,
Absolutely.
whatever I'm assuming, whatever the thing is in my mind.
Absolutely. This is a very risk-defined strategy. Great for novices. Limited risk. You know, whatever the maximum premium you've paid between the two, you've obviously paid more premium for this. You've received less premium for this.
Correct.
So that difference is your maximum loss. So you can fill it and forget it. You know,
True.
leave it. You don't need to look at it. You know, let the market do what it does. Bear the loss at the end of the day, or then enjoy the full profit. You know, these kind of strategies are not in that sense as speculative as entering into a naked position, naked call or naked put, and then constantly monitoring the market. And you know, it's a very limited risk strategy. So perfect for starters. So similarly, a bear put spread, you'll do the same thing with puts. So let's say you think that the market will go down till 8,500 from current. So you'll buy a 9,000 put and you'll sell a 8,500 put. So this becomes a bear put spread because you are bearish in the market and you are creating the spread with puts, and because you're using two strikes, it's called a spread. Like that. Short straddle. Anything which you do with at the money options is referred to as straddle. So let's say you think that the market now will be range bound and it will close somewhere near 9,000. The IVs are very high, and I don't think now means the fear has subsided, and I think it will be range bound between 8,000.
Again, your voice is buffering. Huh? Voice is buffering, Umesh. नहीं सुनाई दे रहा.
Can't seem to help
Voice
it,
is
man.
fine at mine. There is no issue.
Fine. So probably I'll reconnect.
Yeah.
I'll come in and reconnect. You continue. I'll reconnect.
Okay. So let's say if you want to, you think that the market is going to be range bound between 8,500 and 9,500. You think that this is the range now. So what you will do is you will sell a 9,000 call and also sell a 9,000 put. So whatever premium you receive is your buffer. Means if the market remains between this particular range, the premium which you have received, you will make money. If on the other hand, you believe that, you know, the market still has a lot of volatility, the IVs have dropped unnecessarily, and a lot of pain remains, and 1,000 point is nothing. So you could buy a 9,000 call and buy a 9,000 put. So this then will become a long straddle. But because we are covering short straddle, we will stick to our sell. Basically, anything to do with a ATM call and put together is called a straddle. That is what the straddle means. Then put ratio spread. So like we created this bear put spread here, where we are buying a 9,000 put, one quantity, correct? And selling also 8,500 put is of one quantity, one single lot. What if you believe that, it certainly can't go below 8,500, like for sure, it's a great support or whatever. And I don't even want to pay this premium between 9,000, means what I'm paying for 9,000 put. Obviously, I will not be able to recover the same amount by selling a 8,500 put, but I don't want to pay any premium. So what you can do is you can, instead of selling one quantity, you can sell two quantities. Now, because there's a ratio in the quantities, this becomes a ratio spread. That is what you mean by a ratio spread. Then what is the iron condor? So it's a name given to two spreads which you are creating with a call side spread and a put side spread. So a long iron condor is where you are selling a call. Let's say you think that the market is range bound between, so the view is range bound between 8,500 to 9,500. Okay. So what you want to do is you want to sell a 8,500 put and you want to sell a 9,500 call. This is what your idea is. If you would have done this, it's called selling a strangle. Okay. So like straddle is with ATM options, call and put is ATM because 9,000 is where the spot is today. Then it's called a straddle. If you are doing the same thing with out of money options, it's called a strangle. Now, we're not talking about a strangle here, we're talking about an iron condor. So if I'm selling a 8,500 put and a 9,500 call, it seems to be good, but there is unlimited risk here. Means what if the market suddenly still goes down by 1,500 points and it reaches like 7,000, 7,500? Then your 8,500 put is going to be in a lot of trouble. Okay, because there's unlimited risk here. Below 8,500, there's loss. Again, if the market shoots up absolutely rapidly, like it has shot up 1,000 points or 1,500 points in the last 1 week, let's say, it goes up again till, let's say, 11,000. So your 9,500 call will then again be into trouble. So to protect yourself from unlimited losses, you will buy a 8,000 put and buy a 10,000 call. If you do this, the above strategy now will become an iron condor. Am I making sense? Any feedback?
Just repeat iron condors once again.
Okay. So we did you understand this part? Selling a strangle, 8,500 put we are selling, and we are selling a 9,500 call.
Yes.
This much we got. Now this, like we discussed yesterday, if you are selling any option naked, correct? We found out that the maximum profit you can make is the premium you've received. But below that premium amount buffer, the loss is unlimited. You remember that part?
Yes.
Cool. So now to protect this 8,500 put unlimited losses, you are buying protection 500 points below. You could buy this protection at 8,400 also. You could buy it at 8,100 also, 8,200 also. That is fine. It would still remain an iron condor. So this is one part. And this is the second part. Instead of selling and buying protection at 9,000, 10,000, maybe you buy it at 9,800.
Okay.
You are getting this buying a protection part. I will show you both the graphs now. We'll go to options tracker and we'll make all of these strategies and we'll see a payoff chart. So you'll get an idea of how it looks without it and how it looks with it. maybe then it will give you an idea of what these extra protections are doing.
Okay.
And why is it called iron condor? Okay. Trying to admit. Vinay, you can hear me? Vinay, can you hear me?
Yeah, I can hear you. I can hear you.
Okay. So we just went through, did you hear about the short straddle and the
No,
put
no,
ratio spread?
no, no.
You missed this part?
Yeah, I missed short straddle onwards. Yeah.
Okay. So basically, whatever we do with the ATM options, no, at the money options is called a straddle.
Okay.
So if the market today is at 9,000 and you're doing anything with 9,000 call and 9,000 put, it's called a straddle. And if
Okay.
we are selling this 9,000 call and 9,000 put, it is called shorting a straddle.
Okay.
And if you were buying both these calls and puts, then it would be long straddle.
Okay.
Similarly, with how we created a bear put spread here, like we are buying a 9,000 put and selling a 8,500 put, one quantity. If you change the quantity of the short, it would become a ratio spread.
Okay.
So a put ratio spread can be created with any two strikes, but the quantities are not the same. It could be this also. This is also called a ratio spread.
Okay.
Reverse ratio spread, but a ratio spread nevertheless. But point is that if you are having different quantities of different strikes, it's called a ratio spread. We'll see how the payoff chart looks because of that. Now, iron condor is like if you're selling a 8,500 put, let's say you believe that the market is range bound between 8,500 and 9,500. Okay. So you are selling a 8,500 put and selling a 9,500 call.
Okay.
But because this is called selling a strangle. Anything which you do with out of money options is called a strangle.
Okay.
Anything with at the money options is called a straddle.
Okay.
Now you have sold a strangle, but you don't want unlimited loss ka risk. So you are buying some protection on the downside. That if the market goes below 8,500, your unlimited losses start, right? So to protect yourself from unlimited losses, you are buying a 8,200 put. And on the upside, 9,500 call, to protect that, you are buying a 9,800 call.
Okay.
So this, when it is like, tightly bound by both sides from unlimited losses, it's called a iron condor.
Okay.
Like that, there are some standard, some 40 or 50 option strategies, which are floating around, and a combination of those get used by even the biggest funds, biggest institutions. They play around with this kind of stuff only. We can create a strategy with futures as well. So you must have heard of covered call.
So buy a future, sell a call. That's
correct. You buy a future and sell a call. So this is protected. If you already have a buy and hold portfolio and you are looking at a, like a limited upside, you basically keep selling calls, and people call it like, earning income like rent. You own an asset and it's not completely true, because, if the value of your real estate goes up, you can actually capitalize on that independent of the rent. But here selling a call is cutting, your ability to earn that upside.
So you're just capping your profit over there.
You're capping your profit. So we shouldn't call it rent. It is, it is like it's like misleading. So we shouldn't do that. But anyways, a covered call is that. Then the same thing, let's say you want a downward protection for this. So because you have bought a future over here, your downward risk is unlimited, right? The future can drop by 20-30%, and the call is not going to save you with that, because because you're selling a call, your profit is limited to the amount of premium you've received. Correct? Because you're selling over here. So now to get downward protection, what do? You have to buy a put.
Correct.
So now if we complete this, we have this same thing, and we sell a call and we buy a put. Now this becomes a collar.
Okay.
So we can see that we add one position here and there and the name of the strategy is different. And it sounds so confusing when if somebody says that, you know, this particular institution only works with callers, you'll be like, yeah, man, must be exotic, man, must be like really smart. But there's nothing to it. It's finally made out of option legs, you know, depending upon your view.
Correct.
There's the view which is most important. Options are so flexible that it can allow you to make a strategy exactly as per your view. You know, your view should be correct.
Okay.
So let's go through these strategies now in options tracker and see how the payoff chart looks. We'll start simple with the bull call spread. Okay. So for bull call spread, are they both OTM or in the money? See, call spreads can be made with any kind of combination. Both can be in the money, both can be out of money. One can be in the money and the other can be out of money. So that depends. It would still be called a bull call spread, provided the option which you've bought, the strike which you've bought is lower than the strike which you've sold, because you are bullish and hence you've bought a lower strike and sold a higher strike. So we'll create a strategy. An options tracker, I had made like pre-configured these strategies over here. So it was like really simple. All you had to do if you want a bull call spread is just select bull call spread. And it will make a bull call spread for you. You know, it was that easy. So let's say we select 30th April as expiry. And 9,000 strike we said we want to buy. It will cost 434 rupees, 32,000 rupees for one contract. Now, I don't want to spend so much because if I do that, so let's say, let's just first buy a call. Okay. Let's see how that looks. So if I'm just buying one single call, it costs me 32,000 rupees. If I see my payoff chart, everybody can see my payoff chart? Can you see the screen, payoff chart?
Yes, yes.
Okay.
Yeah.
So 9,000 is where I've bought it. Below 9,000, I'm losing this whole 32,000 because I've paid premium for it, correct? I will start making money after this premium amount is fully recovered. So at 9,450, my profit starts. And then, of course, as the market keeps going up, I make more and more money. So if it goes to 10,420 days, I will make 72,000 rupees. But the chances are less, right? Means it will go so up. So I want to limit my risk. So now instead of long call, now I'll make it a bull call spread. So I will buy the same 9,000 call. But now I also want to sell 9,500 call. So I'm selling a short call of 30th April only. So 434 rupees is what I paid for it. But I recovered 14,400 rupees by selling this 9,500 call. So my net outgo now has dropped to 18,150.
Okay.
Okay. So now if I see my payoff chart, my below 9,000, my loss is now limited to 18,000 instead of 32,000.
Correct.
But now when the market goes up, my profit is capped at 9,500 at 19,000 rupees. After that, the loss of the 9,500 call which I have sold will start kicking in and it will counter the profit of the long call. But my loss, my profit is also limited now. It is not unlimited. The line is not going up continuously. So now this becomes my payoff chart. So this is, if you understand how to read this also, that where exactly the break even is happening. So at 0, this is the break even line. So at 9,250 is my break-even line. Earlier, my break-even was 9,450. Now my break-even point has dropped to 9,250 because I've recovered some money from selling this 9,500 call.
Correct.
So it is giving you a breakup over here. Like if the spot is this much, at 9,000, what will happen? 9,500, what will happen? What will the long call do individually in terms of profitability? And what will the short call do? And what would be the total? So it is telling you that at 9,242, your break even will be zero. Means the profit will be zero, which is basically the break even point. So this is how you understand a payoff chart. Reading the chart is clear? Right?
Yeah.
Yes, yes.
Okay, cool. So let's go to the next strategy. Next strategy is bear put spread. I will start with a long put. We will buy a long put, one particular lot. It's costing 363 rupees. So my cost will be 27,000. We see the payoff chart. It shows that above 9,000, my loss is limited to 27,000 because that is the premium I've paid. If the market goes down, let's say it goes till 8,000. So at 8,000, I'll be making 47,000 rupees on my investment of 27,000. And if it keeps going down, then the profit will be unlimited. It can go 1 lakh, 2 lakhs, whatever, depending upon how low the market goes. So if you see that the spike is happening like this on the left hand side, you know that the strategy is bearish because the strategy is making money when the markets are going down. From 9,000, this is where the underlying price is written. So from 9,000 to 8,250 to 7,500. As the market keeps going down, the strategy keeps making money. So this is long put. Now we shift this to a bear put spread. Same thing, we will buy a long put of 9,000, but now we'll also sell a 8,500 put. So 363 is what I pay, 214 is what I receive. So instead of total 27,000 outflow, now my outflow is dropped to just 11,000. So my maximum loss is now capped at 11,000. So we see the payoff chart, and again you'll see like a range bound payoff chart where the loss is limited to 11,100. And if the market is going down at 8,500, the profit is 26,000. But below that, then it is capped at 26,000. There's no more money to be made below the point of the option which you've sold. Okay. So this again becomes a range bound. You can see the breakup of the individual legs here. What will make money and what will lose money. Like that. Let's go to the third. So bull call spread, bear put spread. Let's do short straddle and put ratio spread. Let's do put ratio spread first. We are already here. So instead of now selling one quantity of the short put, 8,500, what if I sell two quantities? Instead of 75, I make it 150. Now this becomes a put ratio spread. Now you'll see that I have paid 27,000 for this. And I have received 32,000 rupees for this, for selling two of this quantity. So now net 4,000, if the market is going up, this 4,800 I will definitely make. But because I have sold one particular put extra, so that particular put is not protected. And hence there's a chance of unlimited loss. We will see how it plays out. Let's see the payoff chart. So we'll see that 4,800, anything above 9,000, I will at least make 4,800 rupees. Okay.
Yeah.
Then the peak profit is happening at 8,500, which is at 42,000 rupees. Because I've made profit of 42,000 rupees, this 42,000 rupees will help me buffer the losses of the naked put for a certain amount of time. It is being able to, buffer me till 7,950.
Okay.
And after that, my unlimited loss starts. So you can see that market today is at 9,000. And if I'm having this strategy, then till 7,950, though my break even is, taken care of. So not a bad strategy, right? That, because the IVs are so high that, the put prices are really high. And that's why a ratio spread, you are basically recovering, most of the, you more than the cost of what you're paying for the put. You can do it with any strikes. Let's say you are saying that no, maybe 8,000 is still risky, but 7,500 I'm really comfortable. So cool. Long put, instead of 9,000, buy a 8,500 put. And instead of selling 8,500, sell 8,000. You will still see that you are recovering 2,430, and now your break even will shift to almost 7,500. Let's see this. So here, anything above 8,500, you are at least making 2,400 rupees. Your maximum profit happens at 8,000, 39,000, and your break even has shifted to almost 7,500.
Okay.
So 7,500 given this 1,000-point rise is pretty comfortable, right? And because you have a long put protecting you, you have like a large buffer where you still make money. On the upside, so you are fully protected. There's no loss only. Let it go to 11,000. You'll at least make 2,400 rupees. If it goes down now, it will go down till where? Let's say it goes down till 7,000. Then your loss would be, let's say, on one would be around 20,000 or whatever, till 7,000. Like that. So we covered put ratio spread. Let's see how a short straddle looks. So like I said, straddle is ATM. Right now Nifty is at 9,000, 9,100, but let's consider 9,000. That's what the example I've taken. So now we do a short straddle. So I select short straddle and the options automatically come up. So, I don't have to, worry about that. So 9,000 and 9,000. So now 30th April. So 434 is the premium I'm getting for selling 9,000 call. 363 is the premium I'll receive for selling 9,000 put. So in total, I will get 60,000 rupees premium, 59,779. So from 9,000, this almost 800 rupees then becomes my buffer. This 800 rupees is the premium I've received. So on both sides, I will get at least a buffer of 800 before which my loss starts. So if you believe that the market is going to be range bound in 800 or so, then this is a good strategy to play with. At any point after 5, 7, 10 days, if the market returns to 9,000, you will be making good money and then you can exit at that point. You need not wait till expiry. So let's see the payoff chart of this. So this says what? At 9,000, your maximum profit is 59,000 because that is the premium you received. If the market expires, this is all on expiry. All these payoff charts which we see are how it will look on expiry. Tomorrow, it could be completely different. If you want to see how it might look tomorrow, you can change the date here. This is saying 0 days to expiry. If you want to say, let's say 20 days to expiry, which is let's say April 10th, which is tomorrow, you can calculate and see that, it is almost making no profit, no loss here. But if tomorrow itself the market drops to 8,000, you'll be losing 24,000 on this. Like that. So on expiry, At 9,000, you're making 58,000. And you'll see because of this buffer, you have an 800 rupee buffer. And on the downside, your unlimited loss starts somewhere around 8,200. And on the upside, it is at 9,773. Like I said, we have like a 800 rupee buffer on both sides. So you can see a payoff chart in option strategies can have 2 break-even points also. It can have multiple break-even points also, like it can have 3 break-even points also. I've seen some payoff charts, but let's not get into that. But there could be multiple break-even points for your option strategies. One for the downside.
Basically, if it stays between 81.73 and these two के बीच में रहा तो profit होगा.
Correct.
That's 8173 and the other one is 9773.
Correct. Absolutely.
So this is the range of my of me making money. 8173 and 9773. And
Absolutely.
above that or below that is loss. Okay.
Correct. Absolutely. Now you say that no, 800 is still not good enough, man. I need at least a 1500 point range. I don't think market will go up 1500 points from here on either side in 20 days. That is a very safe sounding strategy. So you can, instead of shorting a straddle, you can short a strangle. So you can short call you at 9,000 plus 1500 is 10,500. So you actually do a 10,500 short call. And on the downside, instead of shorting a 9,000 put, you short a 7,500 put. Now this then becomes a short strangle. Of course, your premium will drop. Instead of where you were getting 800 rupees over there, now you will get only 100 rupees here. 70 plus 23, 93. But if you see the payoff chart, now you're from 7,500 to 10,500, you are making money. The same amount. Your unlimited losses start now about 10,600, which is like 1,600 points away. And your unlimited losses on the downside start below 7,400, which is again 1,600 points away.
Wow.
If you want more security, there are ways and methods to, convert your option strategies to make it as safe as you want. So
higher the safety, lesser the payout, no? But
what?
Higher the safety you take, lesser will be your profit.
Absolutely.
So because you're buying safety at every level.
Absolutely. Means that is a unspoken rule of the market. The markets in that sense are of course efficient, that they will not allow you to gain more premium at lesser risk. There is no such strategy. Means on a broad-based point of view, based on your view, you can think that the markets, are going to trend, and then you can buy options, and you can have very limited risk and a very high payoff. But that is not because of, the way the options are priced, but because of your view. Your view is directional, and you are right on that, and hence you could make that money, like that. But in terms of efficiency of options and all of that, there is no strategy which will tell you that, okay, this is less risk and more return. It's not possible.
Correct.
Like that. So now we did short straddle, we did a put ratio spread, we iron condor. So this similar thing where we are shorting a 7,500 put and a 10,500 call, gave us 100 rupees. Okay, almost 93 rupees. And 6,900. But still we saw that, there is unlimited risk on the downside. What if the market actually goes to 7,000 or 6,500 or it rises back to 12,000? I don't want to take that risk. I have hundreds of crores to deploy, and I am handling my clients' funds. I want absolutely, peaceful returns. And let's say, instead of 7,000, I have 75,000 quantity, let's say, on this. And, I'm getting 69 lakh rupees over here. So I'm like, yeah, chalega, yaar, 69 lakhs nahi milega, chalega. But who's going to pay 80 lakh rupees loss if this goes to 7,300? I don't want this, or whatever. What if it goes up? My loss is almost 1.5 crores. So with bigger quantities, everything becomes dynamically different. So now I
Correct.
can say that, no, I don't want to have any naked positions. Let me have an iron condor instead. I still don't mind. So I'll shift everything to 30th April. I still don't mind my same 7,500 put. So this is call. So I don't mind my 10,500 call, which we were now playing with. And I still don't mind my short 7,500 put. They seem to be very safe, but I don't want unlimited risk. I don't mind lesser return, but I don't want unlimited risk. So now I want to protect this. So I will go a little further down from 7,500. I'll actually buy a 7,000 put. So I have received 70 rupees over here. I will pay 40 rupees, no problem, but I want security. And for this 10,500, I'll buy a 11,000 call. So 23 rupees is what I've got, and 9 rupees I'm willing to pay for it. Okay. So instead of my 6,000 odd return, now my returns have dropped to only 3,300. So my returns have become half. But we can see, okay, this is like going beyond the chart only, but beyond this, it basically it will flatten out. Let's choose another strike. 7, let's do this with 8,500. And here, let's do it with 9,500. पेज ही नहीं आ रहा है. So this is how an iron condor looks like, where your profit is limited. It's, you know, it's capped at a certain value. Then as the unlimited risk starts, your protection kicks in, and then your loss also becomes limited. It is one of the safest strategies you can do. It is being done by institutions mostly, like with very, very big capital. But the returns are so small that retailers generally shy away from it. You know, and you have to have like a lot of patience, wait like through the month, not touch it. And you know, if there's a loss, you bear it. Go to the next month. Keep doing it month on month, month on month. You can still, I think with today's IVs, so you can still breach almost 15, 18% return just with this. Like if you earn your 15,800 between 8,500 and 9,500, which is like a good range, 1,000-point range, or let's say 8,300 to 9,700 is your break-even point. If you earn any money over here, for this 15,000 rupees, you are only shorting 2 options, which is basically going to be around 2 lakhs capital. Correct? Around 2.2 lakhs, 1.1 lakh is shorting one option. We can go to zero the margin calculator and we can do that calculation also if you all want. You know, how much, what is the return on this particular strategy? You know how to calculate margins and all that? So Nifty 30th April calls, let's say 9,500 we are selling. Then we are selling 8,500 put. We are selling, and we are buying 8,000 put, and we are buying 10,000 call. Okay, so total margin required is just 1,41,000. On 1,41,000, I can earn 15,000 rupees, which is 10% in 20 days. So if you take this much larger, I think 2%, 3% return to aaram se milna chahiye. And if you constantly become profitable in this, let's say 2-3 months, even if you're losing money, you lose limited money. That 20,000, let it go. So let's say 3 months, 3 or 4 months, even if you are 3 months you are losing, 3 months and the balance months you're making profit. So let's say 3 months profit goes to cover 3 months losses, and the balance 6 months you are genuinely profitable. Even then the returns are so good, because the IVs are so high, like that. So this is the iron condor for you. So this can actually be recommended to, even HNIs or people who don't have an idea about options. And these are exotic, asset classes, but these are extremely liquid. They are being bought and sold in the market. And with knowledge, you can, capitalize on this opportunity. Means what other asset classes are there which you can, so dynamically play with. So why not use the opportunity? Just apply your mind. And people think that because it is FNO, it is like very risky, and it is like wealth destruction and this and that. But if you're buying protection, if you're not getting greedy, then where is the risk? Means if I give you a bet which is so range bound and I tell you that you can earn like your 2-3% return in a month, then where is the risk? Provided if you buy the protection. People feel, अरे यार इससे ज़्यादा नीचे नहीं जाएगा यार, इससे ज़्यादा ऊपर नहीं जाएगा. That is where that view comes in. After that, all the problems begin. But if you follow strategies with discipline, like my current strategy, which, it would have made most money if the markets would have gone down. Like at 8,200, it is going to make its maximum money. The markets are going up. Okay. I have like a ratio ladder, like a put ladder spread. Can you see my Tradetron screen?
Now, yes.
So this Twitter manual is a strategy which is live in my broker account. So it is still making 2,33,000 even after the market has gone down, even though my delta is negative. So it is risk defined. If I see the payoff chart on the upside, my losses, it can't make any loss. And if it goes down at below 8,200, means which is where my short put starts, this has a potential to make almost 17-18 lakhs.
Okay.
20 days. This is how the payoff chart looks here. Of course, Tradetron we'll cover tomorrow more than that. But yeah. Let's go. Some issue. Doesn't matter. Basically, yeah. So if you're having like risk defined strategies, I don't see any reason why one should worry about the leveraged nature of options or, the unlimited losses. The unlimited losses are because of your positions. They are not because of options per se. Protect it and then there's no unlimited loss. It's like ironclad, and that hence the name Iron Condor. Like that. So covered call. Go back to, again, you can select covered call over here. There you go. Yeah. And it says you can do a long future with a short call. And we can see that the profit on the upside is capped. On the downside, there is unlimited loss, as with futures. So if we just see a long or a short future, you'll see how the payoff chart looks. It's just a straight line, as we are used to. That if the market goes up, you make unlimited profit. If the market goes down, you make unlimited loss. This is how a future payoff chart looks.
Correct.
So you can create these futures with options also. They are called synthetic longs. So we can go into that also if somebody is interested. It's exotic option management, and the payoff chart will exactly look like this. So I'll give you an example. So if see synthetic long. So if I do a long call, so my upside is unlimited. And if I do a short put, my downside is unlimited. So if I do both of this together, if I do both of this
The
together,
same thing. You're going long both sides.
you're basically having a payoff chart which exactly looks like a future.
Correct. Correct.
So this is called a synthetic future. You're creating a futures position using options. So now this also presents an arbitrage opportunity that if the synthetic future is cheaper than the real future, then you buy the synthetic future and you short the real future. So it becomes an arbitrage. So this is handled via a concept called put call parity.
Okay.
You can look it up. It's a deep topic. We can't handle it now. Put call parity. Just look it up and read about it. It defines the relationship between the price of the call and the put option. So this put call parity, there's a formula, and there are a lot of these high frequency algos which are running co-located at NSE, which just look for these price differences, and they basically run arbitrage algos. So as there's a mispricing in the call or the put option, it will collapse that by buying or selling till that particular price where the put call parity is restored. So these arbitrage algos do that. Okay, so now we did covered call, caller. So again, we go for caller here. So again, long future, short call, long put. Because we had upside was limited and downside was unlimited. Now using this short call premium, which the money which I have earned by selling this call, I'm saying I will buy a put for my downside protection. So I got 375 rupees by this call, but I'm spending it on this particular, so my downside gets protected. So now my upside profit is limited to 2,800, but my risk is also defined now, and I won't lose more than 4,600 because the put will then kick in if the market goes down. So my portfolio is protected. But if I feel that no, 2,800 is too less, means I want at least some upside. So all I can do is instead of 9,100 call, I can sell 9,400 call instead. So I'll get 200 rupees. Cool. At least the market keeps going up. My delta is still positive. So it is still a bullish strategy. So now I earn 12,200. But then my loss also increases to 17,000. So yeah, no free lunch. Like that. So this then becomes a caller. So yeah, we've covered all of these strategies and their payoff. Any questions? You want me to cover anything else?
I guess these are good ones. ये खाली just give that PDF again.
Yeah. This I will share
in the chat.
Yeah, I'll do that.
Umesh, after you making a strategy in a suppose beginning of the month to a particular view, then how you adjust the strategy? Because suppose your view is going wrong or something like that, or IV increase or decrease beyond your imagination, how you calculate. So
Correct.
how you adjust the in between of the month?
So you basically have those rules set before you start a strategy. That if this happens, I will do this. If you're doing it midway, that means again you're going into discretionary trading. I'm not saying that's wrong, but it will lead you into some kind of trouble someday or the other. So let's say I started this strategy, which is currently live. I started with shorting an extra naked put at 6,100. Okay. Now the market just kept going up. So this position was making money, but now only 13 rupees was there remaining. So my maximum profit over here was just 50,000 rupees. And that would have not been enough to cover the cost of this bear put spread. If you see, I have bought 8,500 put, it is long, and I have sold 8,200 put, which is short. So now there's a cost to it. There's 2,79,000 cost. And it was, I had only 50,000 rupees remaining. Of course, the whole strategy is in profit. But I still wanted, okay, now the market has gone up and the theta is going down. So I shifted my 6,100 short put to 7,000 short put. This I did today. This is all today's trade. So this is called repairing a strategy. I have repaired the strategy by shifting one position from, so I have made the strategy a little riskier. My earlier break-even point was 5,700 Nifty. Like when Nifty goes to 5,700, when my loss would start. Now my break-even point has shifted to, let's say 6,500 because I have shifted this to 7,000 put. So, to answer your question, you can do it based on anything. You can do it based on whether your view is going wrong in the spot, or whether the theta is dropping by a certain amount, or there's a certain number of days remaining to expiry, or you have reached a profit target or a stop loss. So whatever your reason might be, just stick to that reason. What that reason could be will change based on your personality, based on the strategy. So I won't be able to give you an answer of what is the right way, because it will change from strategy to strategy. Let's say you have an iron condor, you shouldn't touch it only. Like let it, whether it is loss or profit, just let it go until the end, because the profit is so limited and your loss is limited. Then you should allow it to play it out fully. But there are other strategies where you need repair, so you can, keep repairing them based on certain criteria.
Oh, okay, thanks.
Hi, this is Sandeep. Why exactly it is showing paper trading over here on this page which you are seeing right now?
Because this particular strategy is deployed at a broker which is not algo enabled, and the quantities are, so this has been executed manually. I'll show you my actual positions with the broker. Wait. You all can see my Odin screen.
Yeah, I can see.
So let's see, security contract, just Nifty. Okay. So see this script name, these three. So I have a 8,500 put long, 4575. Then I have a 8,200 put, which is short. I've sold this. Net quantity I can see here. See this net quantities. And then I have a 7,000 put, which is again 4575. And if you see today's trades, like I said, this is the shift which I did. I basically squared off my 6,100 put. I bought this and I sold 7,000 put. The net quantity is 4575 here. So for today's trade, there was a profit of 5,700. And because the delta of my full strategy was short and the market went up by almost 4%, my today's MTM was minus 1 lakh. Yeah. And I have some other positions also which are bullish. So I have a Reliance 680 put. I have a HDFC Bank 600 put. So this is, according to me, I really call this like free money. Means I don't think Reliance will go to 680 in this expiry. Means there's really no reason for it to drop 40%, or HDFC Bank to go to 600, or let's say ITC to go to 120. So these are the puts I have shorted, which according to me are extremely safe. But still there is money to be made here, which is like unbelievable. For me, it is. So there's almost 50,000-60,000 rupees of premium remaining here, which I will recover by the end of expiry, which is just 20 days away.
I'm so sorry. Actually, I'm not able to understand the logic behind buying this Reliance 680 PE.
No, this is not buying. I've sold it.
Sold it. Yeah. Yeah.
Let's
Put
do
option.
this. No, let's
Yeah.
do this. I
Yeah.
sell this 5,000 quantity, 680 put. Let's go to options tracker.
Yeah.
So I can shift this Reliance to Reliance, and I want to do a short put. And I select, so the market Reliance is at 1,223 today, okay? And I'm saying I've sold 680 and still it is available for 2 rupees 50 paisa. And I've sold
Right.
5,000 quantity.
It's almost like 50%.
50%. Will Reliance lose 50% of its value
No.
in 20 days?
No.
That is why I'm calling this free money. That itna to banega hi. Above 680 rupees, I will at least make this much. My loss starts below 680. But then see how the loss becomes like too rapid. Like if it goes to 600, I will lose 3,87,000 rupees. And my maximum profit over here is just 12,500.
So
But
almost we spend around 10,000 rupees.
No, we have not spent. We have received. I have sold this.
Okay.
I have sold this at 2 rupees 50 paisa. See the negative value over here.
Yeah, right.
So I sold this at 8 rupees. So I earned almost 40,000 on this. So my maximum profit was 40 and my unlimited loss starts below 680. So I chose the lowest strike. I'm a pretty conservative person. I could have sold even 800. You know, even 800 is good, right? 800 pe Reliance kahan bura hai yaar. So I could have done this also, but I was very conservative. So I sold 680 put, which was the lowest put which was available at 8 rupees. So this is like free 40,000 rupees, right? Like that. Making sense now? So all of these short puts.
Yeah, right. It's 6 rupees right now in Zerodha. Reliance April 800.
Yeah, exactly. So, you know, I don't think Reliance will go to 800 also in this expiry.
Right, right.
So I shouldn't be calling it free money. It's wrong because there is a risk involved and anything can happen. But I don't know, man. This is like very juicy. Means at 800 or 600, one should buy Reliance, whatever they can. Means then you look at it from a buy and hold portfolio kind. So again, you see short puts are paying you money. You know, this is called cash secured puts. This is how it is called in America, cash secured puts. What this means is you are just shorting a put. Okay. It is just writing an out of money put and set aside enough cash to buy the stock. If it goes below that price, just buy the stock. You know, all these really good companies, they are not going to become like your JP group or whatever, no? So see the puts which I have shorted. They belong to Reliance, HDFC and ITC. So ITC I have shorted 48,000 and this also I shorted at 1 rupee. Right now it is at 45 paisa. Now 120. Like why will ITC go to 120? Yeah. So if I do a ITC 120 at 45 paisa, I basically did 48,000. So this 21,000 is still to be recovered. Balance profit has come into my account. But my loss, if you'll see, will start below 120. Above 120, there's a standard profit.
Just a request, is it possible you can show me this in Zerodha? Like how exactly you're shorting?
Yeah, it's very simple.
Yeah.
You can see my Zerodha screen.
Yes, yes.
So I want to short one ITC 120 put.
0.45. Yeah.
0.45. ये इधर आ गया. Just click on sell over here. and put a limit order.
Okay.
Okay, I want to sell it at 0.25. Increase the quantity how much ever you want to, and click on sell. That's it. Same for Reliance. Reliance 680, put 2 rupees 50 paisa, sell 5,000 quantity. Always do a limit, don't do a market. Sell. Getting rejected, but yeah, it's that simple. Just selling a particular contract is shorting a contract. But don't means just learning this half baked and you sell any other put which is like in the money, or instead of 680, let's say you by mistake sold Reliance, 1200 put, then everything can change. Huh? So you have to be careful, right? So selling Reliance 1200 put at 63, even though you are getting 63 rupees over here as compared to just 2 rupees over here. But this 63 rupees is still riskier. Because 1200 से 63 rupees नीचे का बफर है सिर्फ आपके पास. अगर ये 1100 तक पहुंचा तो you will be losing 40 bucks.
Yeah, right.
So this 680 is so far away that it's safe because it is so far away. Like that. And on the upside also, let's say it's reached 1200. Let's say you do a Reliance 1400 call. See, it's giving you 12 rupee 95 paisa. Like 1400 से Reliance गिरा था. तो अभी इतने डैमेज के बाद कुछ भी डैमेज नहीं हुआ and it goes back to its original peak is unlikely. So this 1200 rupees can be, looked at shorting. अगर 1400 भी कम safe लग रहा है तो Reliance 1500 call. Or you can do both. Along with your Reliance, now this becomes a short. Tell me what it becomes if I'm shorting both the call and the put. I just taught you all.
Strangle.
Correct. So we can do a short.
Future, I guess. Yeah.
We can do a short strangle. ITC का भी कर सकते हैं, Reliance का भी कर सकते हैं. So now you can just play around with your strategies, add them in your paper trading, monitor them, see over 2-3 months if you're making money on your decisions or not, and then go live. There's nothing like live trading to teach you a few lessons. Start with very little capital, start with one lot, and then learn as you. There is money to be made in this, that is certain. If you're doing it.
Do we have any software for paper trading, or it is just on the notebook? We have to check the price and then after what is the cost going on.
So for now they have stopped taking. You can make an account at Tradetron. I will show you tomorrow how to create the same strategy in Tradetron. That's tomorrow's agenda. But Option Tracker, these guys have stopped making new accounts. There are other softwares also. You can use this, yeah, Opstra. You can Opstra. Option Builder. Yeah, use this. It's good. Take a screenshot of this page right now. Opstra.define edge. Just click on Get Started. Add your positions here. So here you can have your options, whatever, let's say we were doing what? So Reliance, we wanted to do a 680 put, right? We add a position, one lot is good. Option strike is 680. And we also want to do a 1500 call. So here, my payoff chart is done. So we'll see that, oh, this is a long. Need to sell. Refresh. Reliance, sell, options, 680, put, and 1500 call. So my whatever little profit is there, but my unlimited loss will start above 1500, and my unlimited loss on the downside will start below 680. यहाँ पे दिखाई नहीं दे रहा, the profit is so low. You know, that's why you shouldn't look at payoff charts like this, because this looks like such a risky strategy that दोनों तरफ से loss ही loss है. But because the range is so wide, like from 700 to 1500, you're covering Reliance. Only after that your losses start. Oh, this is 680 call. ये कहाँ से आ गया यार? 1500 गया ही नहीं वो. 1500 करो ना भाई. ले ही नहीं रहा. Some issue here. Anyways, this is what it is. So what else? Got an idea of how option strategies work and how to look at the payoff chart and how to play around with it?
Yes.
Good.
Good.
Anything else you want me to cover?
Yesterday you were saying that you went for training in Sion location for many days when you started your career. I think
6
just
years
guessing.
back. Yeah.
Yeah. So how exactly you which field you belong to, and how exactly you thought to get into this market? How much time you required? How much effort you have to put to learn all this? Because these are very technical things, and I'm not from this background, so for me it is little difficult also. So I'm just trying to understand.
No, so I am from a financial background, means my education. I've done my MBA in finance. But after that, I was in the software field for 20 years. So around 5 or 6 years back, my software division had shut down at that point. I had parted ways with my partner and I was looking for other business opportunities. So then a friend recommended that, you know, given my mindset, he thought that I would be good for the stock market, or I'd be able to handle all the pain which it brings with it. So then I started my journey. I chose options because they were mathematical and they were like, you know, something which I could, they were like objective. Like technical analysis, I'm still not a bigger fan of, because, you know, two experts also can't come to the same conclusion as far as technical analysis goes. But options, they're objective. Every single expert will tell you the same thing in terms of, what these Greeks mean and, what they represent and all of that. So I wanted to start with something like that. So I just looked up for a course online, and Growth Avenues was the name of the company. And the professor I had over there, Manoj Shinoy, was like really good. And so we had a 3-month class. So that was just the basic. Like I was as confused as you all might be right now. And because I had zero experience with options myself. Then because I had a software field knowledge, I basically thought that, you know, all of this, what they're teaching, it can be really smoothened out by using a software. So why not create one? So I partnered with my professor only, and I started creating options tracker. So then while creating options tracker, trying to explain the whole concept to programmers and trying to get the site up and running, that is when I learned options like really deep, because I had to understand how a payoff chart is, functioning, what kind of, how each leg behaves. So more than trading, I actually learned while creating the software. Then of course I started a fund of my own also. And then that led to, me realizing that we need to get into algo trading. And then algo trading itself is very difficult for retail players to, get into. And that's when Tradetron happened, which we'll cover tomorrow. So yeah, that's pretty much the journey of the last 6 years.
So basically, for a fresher like us, when we go on YouTube, there are many videos available on options or share market. How to create your own strategy that because there are so many people, they keep on saying the same thing but different ways, or maybe because of their technical points are different. So we I feel confusing sometimes. So how to understand which way to go?
Start with
Yeah.
a view. Start with what you think the market will do. Do you think that the market is range bound? That is a view. Do you think that the market is bullish? That is a view. Do you think the market will go down? That is a view. So you start off with that. Do you think that the IVs are high? That's a view. Do you think the IVs will fall? That is a view. So now you have a starting point that I want to accomplish this view. From there, you begin that, all right, what are the possible scenarios to accomplish this view? So let's say you're bullish. It can be accomplished with buying a future. You say, no, it is too risky. I don't have the margin. Okay. So then you say that, all right, I'll instead buy a call. So then that becomes your one strategy. Just buying a single call is also a strategy. Then you say, no, that the premiums are very high. So I know I need to sell something as well. Then you sell a call. Then that becomes like a bull call spread. So that becomes another strategy. Then you say, all right, bull call spread is there, but this premium is also too high. And I don't think that the market will breach 10,000. So then that becomes another view. Now you have created a ladder. You have bought 9,000 call. You have sold 9,500 call. And you've also sold 10,000 call. So now suddenly you have another strategy. You're getting what I'm saying?
Right, right.
So you are starting off with a view and then figuring how to accomplish that view using options. You don't need to listen to anyone. Start with your view and learn how to accomplish that view. That is how you're going to learn. Copying somebody's trade, even if you make money, you've not really done anything. People will keep changing. People will keep getting replaced. It's no fun. Learn to fish. Don't copy anybody's trade. It's no fun. Even if you make that 1 lakh, 2 lakh, it's not worth it. Rather lose money and learn the shit.
Thank you very much.
Yeah.
Sure. Cool.
Made sense today?
Yeah. Of course. Of
Yeah.
course.
Cool. Glad you're sticking to all 3 days. There's tomorrow. I think there'll be 5 participants. We started with 28 to 16 to 9. Yeah. Tomorrow is last.
I'll share that sheet. Put it in the chat. I'll download it.
Hold on. I'll do that now because then the chat will disappear.
Yeah, that paper trading software name is Opstra, right?
Opstra, yeah.
Opstradefineage.com. Okay.
Yeah. I can share the option stack on this also. No problem. But
Umesh, tomorrow is the same time? Because tomorrow is a market holiday.
Yeah, we can do it even though it's a market holiday.
Yeah, the same time, no?
Yeah, 4 to 5.
Yeah.
Lesson 3. I like to approach very difficult concepts and topics in the way I'm presenting this. First understand the whole macro view and just take in and fill in the outlines of it and then go deeper into it. So now, otherwise this whole thing could take like 3-4 months also if you go deeper into Greeks and you go deeper into, each particular strategy. They are in technical analysis also. There are like 400-500 pages book written on just one topic, one indicator. Like if you pick up RSI, let's say, which is a relative strength index, there will be like multiple books. But it's become so complicated to see one topic in depth and we don't know where to put it in the larger frame. So here we have started with like the basics. We've gone finally till algo trading. And all right, this is the final thing. This is what this thing is used for. And of course, then you go back and see what you do not understand in either a strategy or in Greeks or how an option behaves or how IV behaves. So of course you'll need to spend more time on that. There's no doubt about that. 3 days is too less, yeah, to understand something like this.
So how, is learning chart is also important in this chart, technical charts?
No. So option strategies, like I don't read charts at all. Means wherever
Okay.
the market is, my strategy kind of remains pretty much the same. My strategy changes based on the theta and the option values because mine is a non-directional strategy. And generally what chart recommends or suggests are directions. Or is the market trending or is it range bound or whatever. My strategy remains the same both ways. But of course, if you have a good grip on charts or technical indicators, then you can make a killing with options. Because with limited risk, you can apply your, let's say you know that the market is down, but let's say 100 points below this or 7 or 10% below this is extremely strong support. Let's say you know that. You basically go and short a put at that support. Or you know that at this point there is like huge resistance कि इधर तक चला भी गया अगर तो उसको नहीं breach करेगा. If your understanding of that chart is that good, then you go and short a call at resistance. So जितना भी premium मिला, you know you can just keep that like that. So both together is like a lethal combination. But I'm not good at charting. Means I don't understand technical analysis very well. So not good for me.
So the pointers which we have learned from like today and past 2 days,
Hmm.
if we learn that at least 60-70% we are done, 70% at least we are done, that we can do a good trading by ourselves in options.
See, a good trader, no, is more than just knowledge about options. A good trader means how when you're having a position, how you react to your profits and losses, what kind of position sizes you have, are you are you disciplined enough? That's another full chapter on psychology and behavioral economics and your
Mental balance.
so
Okay.
all of that I think is a much bigger portion of whether you'll be a good trader or not. Like there'll be somebody out here who's learning options from me today, and it is possible that I might have more knowledge than you in options, but you could be a much better trader because how you react to losses or what you do when you're under pressure is different from how I react. That is really, really important. Your comfort level with your positions, your comfort level with your trading, you not getting hyper, not getting excited with profits, not getting, scared of, drawdowns. All of that is really important. So I can't answer that, knowing 70% of what I've taught you will make you a good trader. Maybe, maybe not. You'll have to figure that for yourself. So I've shared the link. See if you can download it. So can we do analysis by see the options OI with this? Give us the insight. Can you give some view? Yeah, a lot of people follow OI also. So if you go to your Nifty chain, the OI which you see over here, what people say, there's a view in the market that wherever the maximum OI lies, so the basic theory is that it is the big money or the smart money which actually sell options and retailers basically buy. And the smart money knows that where the support and resistance are. And even if they know that at that point they are ready to buy or give support to a particular price. So let's say here 7,500, there are 2 million open contracts for Nifty on 30th April. So this is like the maximum OI level. Open interest is at 2.1 million here. So this then one can suggest is like a very good support level. On the other hand, let's say on the upside, 10,000 there's 1.6 million contracts open. 11,000 there's 1.1 million contracts open. So like that, so let's say one can say at 10,000 is a good resistance and market might fall once it touches 10,000 or it goes down to 7,500. So you are looking at open interest and you are coming to the conclusion of what seems to be a good option to short. Does that answer your question? HP. Yeah.
You need to start swimming, yeah, to learn swimming.
Come again?
I'm saying you need to start, you need to get into the water to learn.
Yeah.
So that's the only thing, yeah.
Absolutely. No
Karo,
way around it.
Karo, have a great time doing it. Sure.
Cool.
Well,
Anything
take
else,
care,
guys?
man.
I'll
See
pack
ya.
up for the day. I'll see you all tomorrow.
Yep.
Yeah,
Take care.
yeah.
Bye.
Thank you very much.
Bye. Bye.
Thank you.
Thank you.
Thank you. Bye.